The Fed just had its interest rate cut, and we don't want to miss this great opportunity to grow our wealth. Rather than chasing large cap giants or rolling the dice on individual stocks, there is a more strategic and stable way to capture the upside of the market. In this video, we are diving deep into small cap ETFs, funds that give you access to the exciting growth potential of smaller companies without the sleepless nights of stock picking. Stick around as I walk you through 5 small cap ETFs that have the potential to take off in this rate cut cycle and double your investment quickly. Historically, small cap companies have been some of the biggest beneficiaries during the rate cut cycle. Most of these companies rely on borrowing to fuel their growth, and lower interest rates give them more room for expansion. Here's the catch. Individual small cap stocks can be incredibly volatile. We as individual investors could expose our capitals to huge risks when owning them. That's where small cap ETFs come in. These funds offer diversification by spreading your investment across a basket of small companies, reducing the impact of any one stock's poor performance. Now, let's dive into the ETFs. Number 5, we have Pacer US Small Cap Cash Cows 100 ETF, ticker symbol CALF. As the name indicates, CALF tracks the top 100 companies in the S&P Small Cap 600 Index. This ETF focuses on profitability, specifically targeting companies with strong free cash flow. Free cash flow reflects a company's capacity to maintain its operations and invest in growth independently, without the need for external funding. This is an important metric to evaluate a company. Warren Buffett thinks free cash flow is one of the most important factors to consider if the company is worth to own. CALF provides exposure to small cap stocks with strong financial health, making it particularly attractive during times of economic uncertainty or volatility. The biggest sectors are consumer cyclical, energy, technology, and industrials. These sectors are well positioned to benefit from a rate cut due to their growth potential and sensitivity to economic conditions. If you have a lot of tech or semiconductor companies, this is a good time to add some stability to the investment portfolio. The expense ratio is 0.59%, which is higher than some other small cap ETFs. It also provides a dividend yield of 1.06%, which adds an income component to its growth potential. In the past 12 months, the fund has grown 12.63%. If this trend continues, your investment would be doubled in 5.7 years. Number 4, we have the Vanguard Small Cap Growth Index ETF, ticker symbol VBK. The fund exposes 628 U.S. small cap companies with a focus on growth, including companies that exhibit higher than average growth potential, typically measured by metrics like earnings and revenue growth. As part of the Vanguard family, VBK only has an expense ratio of 0.07%, making itself as one of the lowest charged small cap ETFs in the market. Here are the top sectors that VBK invests in. Technology and healthcare are 2 of the largest sectors known for their innovation and growth potential. MongoDB is a good example, a leading database platform provider specializing in cloud-based solutions. In the past 5 years, the company's revenue went from $421.7 million to $1.6 billion. On average, the growth was 41% per year. This is incredible, and not easy for big cap companies to achieve. A prime healthcare holding in VBK is Exact Sciences Corp., known for its pioneering work in early cancer detection through non-invasive diagnostic tests like Cologuard. With an aging population and the growing importance of preventative healthcare, Exact Sciences is positioned for robust growth. Similar to MongoDB, the company's revenue went from $876.3 million to $2.5 billion in the past 5 years. On average, this was an amazing 30% per year in growth. In a low-rate environment, investors typically seek out riskier assets that offer higher returns, such as growth stocks. VBK's holdings are full of companies with high potential for future earnings growth, making it a compelling choice in a rate cut cycle. In the past year, VBK has had a 24.15% increase in share price. If this trend continues, the fund will be doubled in 3 years. If you guys like this content and find it helpful, please hit the thumbs up button and subscribe to the channel. Thank you so much. Now, let's move back to the stocks. Number 3, we have the iShares Russell 2000 ETF, with ticker symbol IWM. Just like the S&P 500 is for investing in 500 big-cap stocks in the market, this ETF is often considered the gold standard for participating in 2,000 small-cap stocks. IWM gives investors exposure to a wide range of sectors, with the largest weightings typically in healthcare, financials, industrials, and technology. These are the sectors that tend to perform better during periods of economic expansion. For example, in the aftermath of the COVID-19 market crash, IWM bounced back strongly with an amazing 20.03% return in 2020, outperformed the S&P 500 of 18.40% in the same time period. Similarly, after the financial crisis in 2009, IWM had a return of 28.51% and outperformed the S&P 500 of 26.46%. It is likely that the IWM will perform very well in the next 2 years. IWM offers an expense ratio of 0.19%, making it one of the more cost-effective small-cap ETFs available. While small caps are generally known for growth rather than dividend income, it only offers 1.22% dividend yield. This can be seen as an additional income on top of the growth. In the past 12 months, the fund already has 25.52% growth, and this has been priced in the good news of interest rate cuts. If this trend continues, your investment will be doubled in 2.82 years. Number 2, we have the Invesco S&P Small Cap 600 Revenue ETF, ticker symbol RWJ. This fund tracks 600 smallest companies in the S&P 1500 index. It takes a unique approach to investing in small-cap stocks by weighting companies based on revenue rather than market capitalization. So companies with bigger revenues would rank on the top. This gives RWJ a distinct edge, especially during periods of market volatility or economic shifts, as companies with strong revenue streams often have better fundamentals and a more stable financial footing. RWJ provides exposure across multiple sectors, with a slight overweight in sectors that have more revenue-driven companies, such as consumer cyclical, industrials, and technology. The heavy tilt towards consumer cyclical and industrial stocks means RWJ could perform very well during periods of interest rate cut. Historically, RWJ has delivered strong performance during economic recovery cycles. In 2020 and 2021, the fund had returns of 20.84% and 50.84%. These are much better performance than the market. RWJ's expense ratio is slightly higher than some of its peers at 0.39%. Given the high growth, this higher expense ratio is acceptable. The current dividend yield is 1.28%. It may not seem that good, but it gives investors some more income other than the growth. In the past 12 months, the fund has had a 26.51% increase. If this trend continues, your investment would be doubled in 2.72 years. Number 1, we have the First Trust RBA American Industrial Renaissance Fund, ticker symbol AIRR. This is an ETF that focuses on small and mid-cap U.S. companies within the industrial and community banking sectors. It is designed to capitalize on the resurgence of American manufacturing and infrastructure development, as well as the strength of smaller U.S. financial institutions. The allocation of this fund is very simple: 88.49% in industrials and 9.50% in financials. The industrial focus means AIRR includes companies involved in manufacturing, machinery, construction, and engineering, areas poised for growth as U.S. infrastructure is modernized and manufacturing rebounds. As the economy improves following a rate cut, demand for construction, manufacturing, and infrastructure projects rises, providing a significant boost to industrial companies. The ETF also includes community banks, which provide essential services to local economies and benefit from a growing U.S. economy. These banks play an essential role in financing local businesses and infrastructure projects, making them critical drivers of regional economic development. In the past 5 years, the fund had a 179% increase in the share price. On average, it was 22.78% increase per year. This is incredible. The growth is similar to the tech sector. In the past 12 months, AIRR has had a 46.98% increase in share price. If this trend continues, the fund will be doubled in 1.53 years. These are the 5 great small-cap ETFs that could potentially double your investment very quickly. As always, make sure to align your investments with your risk tolerance and long-term goals. Thank you for watching, and may you have a profitable investing experience.